Ladies and gentlemen, let me take you back for a moment. Go back to yesterday. Go back to Christmas Day. Go back to that moment when I turned this camera on and interrupted your holiday and told you something most people didn't want to hear. I told you the market was already broken. I told you the calm was fake. I told you liquidity was gone. I told you we were standing in a dry room filled with gasoline, waiting for a spark. And I told you one more thing. When markets opened on December 26th, the price would not creep higher. It would not grind. It would not trend. It would jump, not move, teleport. Now look at the screen, $75.14. That was the high. We closed near $74.50 after a shortened holiday session. Nearly a $4 gap in a market that usually struggles to move 40 cents. This was not a rally. This was not bullish sentiment. This was a structural failure. We didn't break the old high. We erased it. There were traders in London who stepped away with silver near 72 and came back to discover their entire short exposure was gone. Liquidated. We warned you. Ghost Week was never about sleeping. It was about surviving. And today the survivors are the ones holding metal. The casualties are the ones holding paper promises. Let me explain exactly how this happened, because today validated everything we've been saying for weeks. Normally, when an asset moves 5%, it fights. Buyers push, sellers resist. Price climbs inch by inch. Today there was no fight. I was watching the market at the open. One modest buy order hit the system. In a normal environment, that moves the price a few cents. But today, the order book was empty. No offers at $72.50. No offers at $73. No offers at $73.50. The system had to search higher and higher just to find someone willing to sell. And suddenly, the price wasn't moving in cents anymore. It was moving in dollars. That is an air pocket. That is what happens when liquidity disappears and gravity stops working. And here's the part that should scare you. This wasn't aggressive buying. This wasn't a squeeze. This was just light positioning ahead of January. If light buying can send silver to 75, ask yourself what happens when real money shows up. Today, confirmed 3 things. First, once we moved above the previous highs, resistance vanished. Charts love imaginary lines, but above the old peak, there are no trapped sellers. Everyone is green. And when everyone is winning, nobody wants to sell. That's how prices go vertical. Second, there's a real floor under this market. Physical inventory is gone. Every attempt to push the price down today was bought instantly. You cannot crash a market that has nothing left to sell. Third, the machines flipped. For years, algorithms were trained to fade rallies. Today, they switched sides. New highs triggered momentum buying. No valuation, no debate, just buy. And notice something else. The financial media is silent. They're talking about tech stocks. They're talking about oil. Nobody wants to talk about silver. That silence is not bearish. It's fear. They don't have a narrative. They missed it. And denial always comes before a supercycle. Now here's the key point. This was day 1. Ghost Week isn't over yet. Thin liquidity remains. And today proved the system cannot handle pressure in this environment. What happens when desks reopen? What happens when traders realize they're short at 71 and the price is 75? They don't argue. They cover. And then there's the spread. While New York was celebrating 75, China was trading something very different. Shanghai just printed a price that translates to roughly $83 an ounce. Let that sink in. New York closed around $74.50. China is paying $83. That gap did not close today. It shifted higher. In a functional market, that spread would vanish instantly through arbitrage. But it didn't. Why? Because the metal can't move. Paper can trade all day. Digits can change on screens. But physical silver cannot be sourced, shipped, and delivered fast enough. That tells you everything you need to know. This is the divorce of paper price and physical reality. Shanghai is the leading indicator. New York is chasing. And the buyers in China are not speculators. They are industrial users, securing survival. When industry needs silver, price doesn't matter. Production matters. That makes demand inelastic. And that is why $83 is not a ceiling. It's a floor. Now think about the banks. They are short. They sold paper at lower levels, and now they are trapped. If they push price down, the arbitrage gap widens and physical drains faster. If they let price rise, their losses explode. That's not a strategy. That's checkmate. Add geopolitics to this, and the situation becomes explosive. When shipping lanes are threatened, when seizures happen, when blockades appear, the risk premium on moving physical metal skyrockets. And the safest place for capital becomes the asset with no counterparty risk, silver. Now, technically, something even bigger happened today. Silver entered price discovery. There is no historical resistance above this level. No bag holders, no memory of pain. That creates a seller's strike. And when sellers disappear and buyers increase, price doesn't climb, it accelerates. Algorithms recognize this instantly. They switch from mean reversion to momentum, from selling strength to chasing it. That's why moves become violent. This is blue sky, and in blue sky, volatility is extreme. You will see sharp drops, fast spikes, widowmaker wicks designed to shake out leverage. This is not a market for borrowed money. It is a market for ownership. Now ask yourself this. If a skeleton crew caused a $4 teleport, what happens when the real money returns? January is a second matters. Institutions are underweight. Career risk is real. They cannot afford to miss this. And the silver market is tiny compared to the capital that wants in. And when whales enter a swimming pool, the water doesn't ripple. It spills. This is why 75 is not expensive. It's discounted. 83 already exists, and that number will not stand still. The only real mistake now is confusing volatility with danger. The danger is not price swings. The danger is being out. This move is not over. It is just beginning. The warm-up is finished. The real game starts when volume returns. Hold steady, ignore the noise, and understand what you're holding. This is not a trade anymore. It's a repricing.
Hello, my dear friends. Welcome back to my channel. Ladies, gentlemen, let me take you back for a moment. Go back to yesterday, go back to Christmas Day, and go back to the that moment when I turned this camera on and interviewed you holiday and told you something most people didn't want to hear. I told you the market was already broken. I told you the calm was fake. I told you liquidity was gone. I told you we were standing in a dry room filled with gasoline waiting for a spark. I told and I told you one more thing opened on when markets opening on December 26th, the price would not crap higher, it would not trend, it would not trend. Okay, it would it would jump, not move, teleport. Now look at the screen. $75 and 14 cents. That was the high. We closed near 74.50 after a shortened holiday session, nearly a $4 gap in a market that usually struggles to move from cents. Thank you.